Well, as the market continues to climb, a wider swath of stocks are joining in on the rally, but cracks are beginning to show, signaling that a trend change could be soon ahead. So just how hard will the market be hit, and can the rally recover? That's the big question. We're diving in deeper to those warning signs now with Mark Newton, Fundstrat Global Advisors, Global Head of Technical Strategy, alongside our own Jared Blikre. Thanks, guys.
Thank you. And Mark, it's great to have you here today. We did a comprehensive webinar last year. Encourage everybody to look for it online. But today we're going to be talking about, let's begin with the S&P 500, just kind of a 30,000 foot picture here. Here's the year to date, definitely broken to the upside here. Just tell me what you're seeing in terms of the market action and what you perceive, what you think is going to happen in the near term future. I know August you think we may be in for a little bit of a tumble.
Thank you. Well, look, the market's proven to be a lot more resilient than I think a lot of people expected heading into this year. And we went from a lot of worries with regards to possible, recession on the horizon, downward earnings revisions, and recently people are saying, well, the market's overbought, there's selective participation. But the move over 4,200 was certainly important, and it's helped to really lift equities. My thinking in the near term is that we are approaching a time when we can see a 3 to 5% correction in the month of August, and that has to do with seasonality turning a little bit negative. It's really one of the worst periods in pre-election years, August and September.
Well, let's dig into that a little bit, and then we can get into some of maybe the false narratives that are being are pervasive right now. Right. So you might be saying, what are you looking for in terms of the market rolling over? Because there are some very specific things on your list, and I'd like to go over some of them.
That'd be great.
Yeah.
Initially we have to look at sentiment having gradually gotten to a little bit more optimistic. Investors are finally respecting this rally, which they hadn't done in months. So we've seen a little bit of a flip-flop in negative sentiment to now more optimistic. We see short covering by institutions. I would argue it's not incredibly optimistic. Everybody I talk to is still somewhat negative on the market. They're waiting for the pullback. They don't want to buy NVIDIA at 450. They want to wait till it goes to 300. And so people are not participating on a larger level, but short term we do see some evidence of investors at least trying to play catch up. A lot of call option buying and initial signs of potential speculation.
Well, and let's talk about some of the things that people have been complaining about in this rally so far. That may not be the case. Low volume. I love this one because I haven't seen index volume be participation in a bull market since the early 90s, maybe, at least at the index level. But no volume, too much concentration. I think we've seen some of that, a lot of that abate over the last month or two, the market rallying. What else are you looking for here? What else are you seeing?
Well, you hear people say the market's overbought, and that could be the case with regards to NASDAQ 100, but certainly not with equal-weighted S&P. So we strip out all these large-cap technology stocks. We see that the market's been down over the last 3 out of 5 months up until we hit the month of June. So that's recently a big broadening out of the rally. And when they say selective participation, they say, well, it's only been technology. And that also is not the truth. I mean, technology has underperformed over the last month. We've seen outperformance out of industrials, out of consumer discretionary, financials, and recently in this last week, healthcare. So those are encouraging signs of the market broadening out that goes a little bit against the narrative of what people are saying.
Yeah, go ahead. I was going to say, I've been looking at tech, which is at, well, if you look at the XLK, that is at a record high. XLI, that's the industrials at a record high. Right. SMH, that's the chip stocks, that's at a record high. Home builders at a record high. So there's lots happening here that show broad participation in the market.
That's true. I find it helpful to strip out a lot of these large caps and look at equal weighted indices as opposed to XLK, because that is so much of a concentration in Apple and Google and Microsoft and this and that. So it makes it interesting to really look at things and how they're starting to show some outperformance.
Yeah. So this is the S&P 500. This is GSPC. That is the purple line. This is the normal market cap weight that you're used to seeing. And then this laggard here is the equal weight. And this just shows that the mega caps have accounted for a substantial part of the rally this year. But you dial this back to a 2-month chart, it's looking a little bit more even. Well, let's just call that even, up 8% for each of those. And then you take a look at the Dow Industrials versus the transports. Transports much more volatile. They have surged recently. Tell us what you're seeing in terms of Dow theory, or maybe does this extend to this analysis that we're talking about, the market cap versus equal weight? Does this apply to the Dow as well?
Yeah, it's always helpful when you see things like the Dow and the Dow Jones Transports join the NASDAQ and moving back above intermediate-term swing highs. I mean, the Dow and the transports last week moved to the highest levels in 15 months, and it's been basing for a long time. So these certainly aren't as overbought as things like the NASDAQ, which people are complaining about. Oh, it's too overbought. There are too many too few stocks carrying the market. I mean, this has been the case for 100 years. You look back 70 years ago, we had the generals, General Motors, General Electric, DuPont. They've always had big percentages of these indicators. So investors have to realize this is not a new normal. If anything, it's an old normal.
I love that. And I'd throw Exxon in there, too, if you were alive in the 1980s,
That's right.
as I was, but not trading. Mark Newton, thank you for being here. We're going to keep you around, and I'm going to send it back to Julie.
Right. Yeah, and that's the exact description of me as well. Alive in the 1980s, but not trading and not covering trading.